The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. So, welcome back to Trajecta Talks. This is the podcast where we explore how smart decisions, real discipline, and the right mindset can give you a serious edge in life, finance, and everything in between. I'm your host, Alex Savanovic, and today we've got something a little bit different, definitely a little special. Joining me is someone I work with closely, someone I've learned a ton from, Ethan Weitz, the founder of Spoonbill Partners LLC. So, Spoonbill is a multi strategy hedge fund focused on identifying asymmetric opportunities across public and private markets. But more than just the pitch deck stuff, Ethan's a very sharp thinker, a relentless learner and mentor, and someone who's built his reputation on execution and perspective. Today, we're going to talk about how he came up in the business, what it took to launch a fund, some of the biggest lessons along the way, how he sees risks, people, and performance in today's markets. And we'll definitely get into some various other fun questions. We've definitely got a few of those lined up. So without further ado, let's cut straight to our interview with Ethan Weitz. How's it going, everyone? So like I said in the intro to this episode, we now have Mr. Ethan Weitz on. Ethan, buddy, how are you doing?
I'm great. How you doing?
I'm perfect. I'm very excited for this episode. I know you're going to have some awesome content for the viewers and hopefully some great stories. So
Uh,
I think we're just going to dive right into the questions. The first thing I wanted to ask you was I know you've been approached in the past for interviews and podcasts, but you usually decline. What made you decide that now was the right time to sit down and finally do one?
yeah, I mean, I guess maybe a little bit more old school, but the idea of selling yourself in finance or self promotion just seemed wrong, and typically correlated to underperformance, frankly. Um, and I never had any outside investors, so the idea of speaking about myself was. I felt no need to do that. Um, and a couple months ago, funny, my brother actually and I were speaking about it, and he said that he's much more in the world than I am. And he said that I was seeing it wrong, that I could actually maybe teach or help someone or maybe give some stories that in some way can offer some direction. So definitely thought twice about it and decided that his approach was probably better for sure.
Before we move on to the next thing, I wanted to ask you. You said you had no outside investors. I feel like that's pretty unique, a little bit rare in this business because all you ever hear is people trying to raise money for a new fund. So for a new fund, sorry. So can you walk us through the decision maybe and why you chose to take that route?
Yeah, I mean, in hindsight, it sounds crazy now, but at the time, um, I definitely had probably a little bit more self belief also than I do now. But the idea was, yeah, get as much of your own personal assets and for me, with as much leverage as you can in one idea or one asset class, and get 100% of the upside. And also obviously 100% of the downside. But I didn't think about it like that at the time. So it was, yeah, I think that's one of the ways to do it. And the other way that's become a lot more popular is obviously more of a hedge fund approach. But for me at the time, that worked, and yeah, it's not something I would probably advise these days. That's for sure.
For the viewers that maybe aren't super aware, could you give us your definition of a hedge fund?
Oh yeah, I mean, I guess the idea of a hedge fund is what it started off as and where we are now with it are two different things. I think the idea initially of a hedge fund was to make two investments. basically one outright risk taking, and the other would be a hedge against that. Let's say you were long an airline stock, and you'd be long on the best oil stock, sort of the highest input cost for an airline. It has since, that's probably started in the late 1940s. It's since morphed into a much more aggressive form of investing with leverage across multiple asset classes, leverage in a lot of cases of more than 2 to 1. Obviously, shorting stocks as well, which is, between that, the leverage and sort of the interests aligned with GPs and LPs, you get these, outsized returns, but also a lot more risk. And that's typically, yeah, I think the leverage and the fact that the general partner is aligned with the performance, I think is definitely a more pure approach, and doesn't get paid unless the LPs make money. And frankly, even in losing years, doesn't get paid until you what's a high watermark, until you get back above even. Obviously, there's guys who take asset management fees as well, but yeah, that's the hedge fund. I can be more detailed, but I think that's sort of a nice broad definition.
No, that's perfect. And I think before we get into any more detail about hedge funds or your opinions on the market, I guess I should have started with this question, but can you walk us through, I guess, a bit of your background, how you first got into investing or trading, how the journey evolved over time? I know the story, and I know that it's a great story. I'm sure the viewers will love to hear it. So yeah, go ahead whenever.
I'm not sure it's great. It's colorful. That's for sure. I'm not sure if it's great though. Yeah, I think it started off as when I was 13. My grandfather gave me stock, gifted me stock in a company called Disney. At the time, that was kind of popular to do to kids or grandkids, because the once you got a stock, you were able to order actually certificate and see what it looked like. And on the certificate specifically was Mickey Mouse. So kind of encouraging for a kid to see that and also own a tiny piece of Disney at the time. And yeah, I started following it and would wake up in the morning and check. I know this sounds crazy now, but check the newspaper on how find Disney in alphabetic order, where it was in the newspaper, and how it had performed the day before. And yeah, Disney did great, and I kind of was really excited about that, and asked my parents if I could figure out how to buy another stock. And the most logical way for me was right below Disney in the paper was a company called Dr. Pepper. So the way I picked it was just easy to follow, because it was right after Disney when you check it in the morning. And you've probably seen me make decisions like that these days. So we bought Dr. Pepper, and yeah, and I got the bug, and that did well as also, and started to kind of get a little bit more into it, and had a chance to go work at a hedge fund in New York when I was 16. And that was coming from the West Coast. That was pretty cool. So I went back to New York, worked for a hedge fund called Steinhardt Partners. And at the time, they ran roughly, or managed roughly, $1 billion. And I know that doesn't sound big in today's terms, but that was put them in situations where a lot of trading, a lot of activity, for me, a lot of information I hadn't learned before. And so, yeah, the first summer basically was just answering the phones and getting essentially screamed and yelled at was kind of the rites of passage there. And by the end of, I had gone back multiple summers, and by the end of working there for, let's say, 4 or 5 summers, I was trading derivatives directly with the general partner. So I had learned a lot. And Yeah, that was probably the most, I guess, seminal experience for me in terms of what shaped me early on. And then after that, finished college and went to work for a firm in Los Angeles called Gruntle,
Sorry,
where
sorry to
yeah,
interrupt you really quick.
yeah, yeah.
I just want to zoom in a little bit on the 16-year-old in New York thing. Can you give us like a little bit more? I know it's such a unique experience. It's so many people that are listening, or people even in the industry didn't start out on Wall Street at that young. So can you give us maybe a story or I don't know, something that stood out to you being that young in New York?
Yeah, I mean, let me first clarify. I wasn't sought after by this hedge fund to come from LA to New York to work on the desk. This was a family friend, so I was fortunate enough to make this connection and work there. I would say that thinking you know something about, at least in my case, I thought I knew a little bit about the world of Wall Street was nothing until I got on the trading desk and watched how um, yeah, just large amounts of money moved with and how it was traded, and as I said, using leverage, multiple different assets, and just a different intensity level than what I ever would have thought. And frankly, in hindsight, then I saw much. I didn't see anything like that after. So yeah, that was. I mean, there's obviously other being 16 in New York. I did not realize, as I do now, how that sounds, but amazing life experiences for sure.
Awesome.
So yeah, that was the first one, and then after that, yeah, like I said, college, and then went to work for a firm in Los Angeles called Gruntle. That was the first time I worked on institutional trading desk with a gentleman by the name of Marty Michaels, who was, besides being just a good human, he was a great trader and mentor. Um, and then from there, went back and worked for a firm in New York called Oppenheimer, where definitely learned more about sales and block trading and getting more comfortable doing that. And that really um, was there for 5 years, and that was incredible experiences. And then when started a hedge fund in, or excuse me, started a fund in Florida, and had some success early on. And then 9/11 came, lost a bunch of friends, settled the lawsuit, and got Graves' disease, and pretty much just hit the wall after that, and just kind of lost all interest in working in markets, and kind of a little bit of a tough time, and spent some time reading and trying to kind of figure out how guys who had a lot more financial success than I did kept wanting to work every day. And at the end, I learned that working's a privilege, and you don't do it just because of some financial goal. In my case, it regardless was a passion. It was something I loved to do, and look forward to Monday morning. I know that sounds crazy. So, and that was that moment there, that time there, I think definitely probably set me on the road properly after that.
Hmm. I just want to really quickly,
Yeah.
you said working is a privilege. I know so many people out there working, whatever job they might be working, definitely wouldn't have that opinion. And I've picked up on a theme in finance, and at least in what we do, so many guys have that mindset. Do you think that contributes a little bit to why we see guys do it well into their 80s and 90s? Look at some of the best they've done it: Buffett, Druckenmiller, Munger. These guys are they don't need to work anymore, but they do it every day anyway.
Yeah, I mean, for sure, for me specifically, I think the only skill set I have, but also um, I do think that the brain food and the constant learning, curiosity, and I think guys would say it's impossible to perfect. Um, we're constantly taking losers and doing things wrong, and trying to kind of perfect what we do, and we struggle, and that's the best part of it. So yeah, I mean, again, it's a passion for me. It's I'm not working in a coal mine, so or doing something with manual labor where it's physically taxing, but it is for me. Um, it's definitely something I look forward to doing.
100%. No, and I've had the absolute privilege of learning the business and you teaching me the ropes. And I guess it segues perfectly into the next thing I wanted to ask you, which was since we've worked together for the last 5 years, I've seen our performance firsthand. I'm also aware that since you've started doing this, you've never had, I don't think you've ever had a losing year, I think it was, which is super rare. So, can you speak a little bit about your investment philosophy and what's contributed to that consistency every year?
Well, I can tell you we've had a couple close ones, that's for sure. I would say, I guess the two biggest factors are, I guess I got into the business thinking, or knowing all I could do was trade stocks, and realized quickly that I needed to learn other asset classes. So I guess the freedom um, to look in other directions, and try to find value and try to find some sort of edge in other asset classes would be one of them. There's a lot of guys who are stuck only able to long only managers and stocks. So that's a big one. I think the second one, regardless of what you're trading, is just the discipline. I don't have to obviously tell you that, but there's, yeah, in your case, I think you still get up at 2 a.m. And since you were 19, you realize the importance of that. So the discipline, regardless, is definitely one of the things, probably the most important thing that I would say that contributes to the returns over a long period of time. And I would say there's, a couple rules that we follow, and that basically helps with the outcomes for sure.
100%. Don't fix what ain't broke, right? It's been working for us for a
That's
few
right.
years now.
That's right. That's
Um,
right.
yeah, no, that's a perfect answer. And I think the next thing I think I want to ask you is, what are you currently focused on in terms of work or investment strategy? What's going on for you with the fund or any other fund? And what's taking most of your attention right now as it relates to markets or life?
Yeah, I mean, I guess with Spoonbill, or what I've done the last, 25 plus years or whatever it is, I'm not as focused on that anymore. That's definitely something you're involved with. I would say the main reason there is because my approach of doing research or reading research, and speaking to trading desk every so often, speaking to analysts, and the kind of ready, fire, aim way of doing things is just dated. And the way that you do it now, which is basically compiling data on every trade versus an ETF versus some other group versus market up versus market sideways versus market down. That's just not the way I used to do it. And I feel like that approach now for kind of daily trading, weekly trading, monthly trading is definitely a better fit. And I think there's no question it's something you have a comfort level in that I don't know if I do anymore. And I would say, yeah, the stuff I'm doing is a little bit more, I guess, investing, and a little bit more longer term, and in some cases with larger assets. And then so yeah, there's that. And then
Wait, let me stop you there really quickly.
yeah,
For anyone
yeah.
listening right now, and you catch Ethan out on the street and you have a conversation with him, he's definitely in this podcast, and he's going to tell you as well that he does the slow twitch stuff. Let me tell you firsthand, I've seen this guy a few times fly in and out like a pilot into some of
Yeah,
these
when you're
names.
not looking, and I
No,
and I
well, it
when
100% still happens.
you turn your back on, I could sneak in there real quick.
Yeah, when I'm at the coffee machine to come back. Oh,
Yeah, exactly.
oh, sorry, I cut
So,
you off. What were you going to
no,
say?
so that's it. More longer duration stuff, and definitely trying to put larger amounts of money to work there. And and I guess living vicariously through my kids' sports as well. So yeah.
Next thing I wanted to speak about was the books. So yeah, that was the books. Investing related or otherwise, what are some books you've read over the years that maybe had a lasting impact on the way you think or operate?
I would say book wise, maybe outside the normal Wall Street books that guys recommend, a little bit more nuanced, but the book The Outsiders, I forgot the author's first name, last name's Thorndike though. Really interesting take on CEOs who were basically consumed on a day-to-day basis with return on investment capital. And true compounders on the ground, not like the compounders we talk about in the investment world, but actually CEOs doing it every day. So I thought that was excellent. The second book, I guess, would be the Ari Kiev book, Trading to Win. You and I have talked about that, and guy was basically a psychiatrist on one of the larger hedge fund trading desks. It's kind of a tough book to get, I think, but I think you might know how to do it, Alex.
Yeah, I
Um,
think if anyone wants access to that book, you can definitely find it on Amazon. It's a tad pricey and there's just not a lot of stock. But if you hit me up on the DM for the show, we can definitely discuss strategies on how to acquire the book. It's a great book, and I think we'll have an episode on trader psychology anyway. We'll talk about that book.
yeah, those would be the I think the two investment books that pop up. And then I guess non-investment books might be the we talk about this one as well, the Carol Dweck book Mindset, which I know people kind of have used a lot in the past, but the growth versus fixed mindset, and at least for trading, that helps a lot because we have losers all the time, and the ability to kind of recover from them and how we see them and how we learn from them really helps on a day-to-day basis, also on a longer term basis. That's for sure.
Could definitely agree with that. There's a lot of losers in this business, and
Hmm.
if you let yourself get knocked down by everyone, I don't think you would last too long.
That's for sure.
um, again, I know you have to leave soon, so I think this will be the last question. And I know everyone, this is probably the one people are dying to know. What's your outlook on the markets going forward from today going forward? Any themes that you think maybe people are underestimating? And I know you could talk about this for a long time, so give us as much as you want or as little as you want. We're going to love it either way.
Let me say one thing. It's the last question. But let me say one thing, and I should have said this earlier. You and I have talked about you doing a podcast off and on for a while. Sometimes it works, sometimes when we grab a bite. And I want you to know, talking about something and actually seeing it through are two different things. And this definitely speaks to your character. And
Oh,
I'm happy you're doing it. And congrats and best of
thank
luck.
you. Thank you. I appreciate it.
Yeah, for sure, for sure. Yes, the markets. I would, I guess, start off by saying, depending on who's listening, if you're just starting off in investing and you're 15, 18, 20s, 30s, you should probably ignore what I'm saying. I mean, the truth is, you should probably know what I'm saying regardless. But um, I would say that, yeah, this for my risk profile or my age fits the way I see the markets right now. Um, I guess I would lead with the fact that, um, yeah, the greatest investor of our generation, Warren Buffett, has managed Berkshire Hathaway actively, doesn't do it anymore. Right now, the structure there is basically they have a third in private equity, a third in public equity, and a third in cash. So anyone who has, in my mind, less than that in cash is being pretty arrogant. From my perspective, that's how I would start. I guess I would see the world right now in three different buckets. The first would be equities, the second would be credit, and the third would probably be geopolitical. Uh, Talk about the equities real quick. Right now, um, stocks trading basically 23 times forward earnings, which earnings yield, if you flip it around, is about 4.35, let's say. 10 years, about 4.3 3.8, almost 4, let's say 4.4, and the 30 years obviously almost, not obviously, but it's around 4.8 and change. So from a valuation standpoint, equities do not look cheap here. That's how I would start there. Let's go through equities and probably the reason why. In the last 10 years, the top 7 names in the S&P 500 have earnings growth of roughly 20%. And the other 493, and they take up roughly a third of the market, actually. And the roughly 493 names have earnings growth of closer to 6%. So huge overweighting in those 7 names, and obviously they've performed really well. And that's sort of the bull story on why guys are buying stocks here. One of the reasons. On the credit side, you have a few different things happening. You have the reconciliation bill from a couple of weeks ago came out with, I think, a lot more spending than people anticipated, probably even higher. I think I read a JP Morgan report, even I think 2 or 3 times higher than the Harris-Walz proposal was. So markets obviously rally on deficit spending. I don't know if that's obviously consequential at some point. The markets had obviously sold off on the fears of austerity, which I think at some point we're going to need. So yields going up there, I'm not sure if they're going up for the right reasons. They typically would go up for growth reasons or inflation reasons. This could be actually spreads are widening or yields are going up because of the fear of the amount of debt we have. It's effectively another $2 trillion a year. The deficit is maybe even a little bit more, adding to $36-37 trillion in total debt. The numbers start to get obviously very intimidating. We've been talking about deficits for almost 40 years now. I don't think the worst case short term is the U.S. defaulting. The worst case is probably rates just going significantly higher. That is, people talk about the U.S. defaulting. A lot happens between now and a default, and the markets would force change if we got close to that situation. Anytime there's a policy error like that, you see markets respond. And then, as you saw with Trump and the tariffs, you see how quickly the markets influence decision like that. And so then regarding tariffs, I would say we're basically at a tariff detente where markets are starting to assume that we're at 10% tariffs, and with almost everyone but China, I don't think there's been a real deal yet in the tariff negotiations. I keep hearing the pushbacks. So I would say I don't think the tariffs are going to raise what the initial number of 800 billion is what I think I saw. That won't be there to help deficits. I think it could obviously hurt businesses and earnings. You see how markets responded, around that first week in April. And then the third is geopolitical, and that's usually a weakness for me because I tend to sort of respond to geopolitical, and geopolitical ends up being very sort of shorter term scenarios that have a smaller weighting in the MSCI, but they feel at the time like a real big deal. Not that what's going on in Iran and Israel is not a big deal, and not that's what's going on in Ukraine's not, but in terms of how the markets respond, you see how markets tend to look past that. So given those 3 different, scenarios, I would say, or explanations, I would say that to me, the credit one is starting to look interesting, and we're starting to put a little bit of money to work in some municipal bonds and some first trust deed loans, but not putting new money to work in equities. Very low exposure there, and definitely a little bit risk averse, I would say, more than anything right now. So, that's hopefully that's not too much, but maybe in broad terms, it gives you an idea of how I see things right now.
No, that's perfect. That's a great answer, and I think a perfect way to cap off this interview. So, Ethan, again, I just want to say thank you so much for coming on to this pod episode. Hopefully, we can have you on again and hear some more stories and hear some more opinions.
Of course, I look forward to it.
Awesome. Well, buddy, I hope you have a great rest of your day. I'll catch up with you soon. And for everyone watching the episode, we're going to head out to the outro now.
You got it. Take care.
Take care, buddy. Bye bye. So, folks, that was our discussion with Ethan Weitz. I hope you learned something new, or at the very least, found our conversation entertaining. There's so much noise out there in this space, and it's rare to hear it straight from someone who's actually doing it and doing it really well. For those of you listening, if you got value from this conversation, do us a favor, hit subscribe to Trajecta Talks on Spotify, Apple, or wherever you're tuning in from. Full video episodes are available on YouTube as well. The link for that is in the show notes below. And if you're looking to level up your financial understanding or plug into a few more resources, check out Trajecta University. That's our educational platform built for people who want to get sharper, faster. Follow us on Instagram, Facebook, LinkedIn, and shoot us a DM if there's someone that you want to hear from next or a topic that you want us to unpack. And don't forget about our stock picking competition I announced on last week's episode. Just DM us some of your picks. We'll cover them live on the show and track your performance. We'll also make some comments on what we saw every week and some of the names you guys selected. That's all we have for today. Thank you so much for listening. I'm Alex Savanovic. This is Trajecta Talks. I'm going to see you guys next week. Have a great Friday. Take care.